The markets are closed today. However, when we look at the S&P over the last week, we are seeing a lot of disparity between the industries. We see the likes of technology and semiconductors up very strongly, whereas others across the board are starting to show some very significant weaknesses. Now, our focus in today's episode is going to be on 5 undervalued dividend kings that we believe are cheap buys for the very long term. We'll look at their historical performance. We want to touch upon their ratings. Do the analysts also believe they are very strong buys? And as always, we will touch upon their dividend safety, as that is a very good indicator for future growth and longevity of this dividend streak. And we'll also touch upon some of the underlying metrics that we do believe you need to understand for each one of these 5. What we're also going to do on today's episode is touch upon the dividend ETF, which is mainly consisting of 30 plus companies that have increased those dividends, as we can see, for over the last 50 years. Just in case this is something you want to consider for your portfolio. And as always, we are going to run to the valuation so you can see why we believe they're cheap, what our intrinsic value is, what our margin of safety is, given our acceptable buy, and exactly whether or not Wall Street do see enough upside for you to also consider in your own portfolios today. The first one is the global beverage and snack company PepsiCo Incorporated, where we have a double buy, Wall Street and Quant, with a hold from Seeking Alpha. Now, this has been trading right there towards its 52-week lows, and this does have now a very nice forward yield, 3.33%. As we're about to come on to, this is the highest yield they have offered over the last 5 years. The forward P now sits below 20. As always, we will look at the sector P for relevancy. Just to let you know, the S&P does sit around 22.5. And over the last year, they are down around 12%. Over the last 10 years, though, we can see up around 82%, with all-time highs just below $200 about a year ago today. Now, in terms of their dividend safety, 93, so it is very safe, which is what we like to see, especially from dividend kings. And their market cap, $224 billion, a mega cap company. Now, in May, it was just reaffirmed that their very safe score is still there, and therefore a dividend cut is highly unlikely. Now, for the recession, what happened, if for those that do believe one is inbound very soon? Well, they increased it during the Great Recession 07-09. They had flat sales. Remember, the S&P at this time was around negative 12, and they also significantly outperformed. Granted, it was negative 35%. It still outperformed the S&P's negative 55. Now, what do we like about this company? Well, one of the things is that growth on the dividend. Nice high single digit this year, high single digit over the last 5 years, and over the last 20 years, this dividend king PepsiCo has been increasing those dividends at a double digit rate. And as we can clearly see, one of the newer dividend kings, 51 years of consecutive increases. Very important to understand when we talk about undervaluation on dividend yield theory, it states a company is undervalued when the current yield sits above the 5-year average. As we can see, severe sign of undervaluation, as well as the forward P below 20, with the 5-year sitting at 24. In terms of the sector, though, we can see it is marginally higher than the consumer staples of 18.1, but as always, we don't look at any of these models in isolation. We will conclude towards the end. Free cash flow payout, now we want it below 70% for consumer staples. One of the issues that I have with this company, which is why I like a larger margin of safety, is the fact that we see the free cash flow payout above 70 consistently. 2022 was a very, very large scare. Reason why, 111% means that management paid out more in dividends than they generated in free cash flow. Nice thing to note, over the next 12 months, this is anticipated to come down to 75, although I would like to see it marginally lower. Free cash flow, as always, we want to see growth on this metric consistently over the longer term. Whilst we get a bit of inconsistency, it still moves in the right direction over the next 12 months. Granted, the expectation is there for that upward trend to continue. In terms of sales growth, well, on our deep dives, 3 to 7%. Over the last few years, it has looked very strong. Hopefully, at a bare minimum, they can keep up with that inflationary level. And we can see over the last 10 years, around 40% growth to their top line. Now, they do return some excess cash to shareholders' pockets through those share buybacks. Very minimal, very inconsistent, so a little bit too trivial to discuss in any detail. We then move on to the ROIC, very important metric, above 12% or more for consumer staples, giving us faith management are able to effectively allocate their capital, and that consistency across the board is something we love to see as investors. And then the operating margin above 16%, we pretty much get consistency across the board, and even though the free cash flow has started to decrease, again, it is still around that 7% we want to see as a minimum. We then finally move on to the net debt to EBITDA, earnings before interest, tax, depreciation, amortization, with these numbers below showing you the number of years it would take the company to pay off all of their debt net of cash on hand. Below 4, what we want to see. Remember why we look at this in detail. It is correlating to both balance sheet strength and dividend safety. 2.03 this year, expected to go lower in 2024. So again, very strong sign of this company. Now, as always, with our essential valuation, we do run through every single one of these models when we do our deeper dives. Today's episode, we're getting straight into the intrinsic value, $189, which is the average of these three models. And with the current price at $162, we always start off with a margin of safety of 10%. Now, we execute on 10% if it meets our three golden criteria: a wide moat, strong financial metrics, good forward-looking data. If you believe that, well, it is a buy around $170 at 15%, not too far off, pretty much around the current trading price. So for this very high quality global food and snack beverage company, we can see a 15% MOS level. For those that are actually looking for additional safety at 20%, it would be 151, but as we said in today's episode, 15%. In terms of Wall Street, they also see this share price not too dissimilar from our intrinsic value. They see upside of 16%, their price target $187. Now, for those that are subscribed to the weekly newsletter, on Monday we will be releasing our Dividend King spreadsheet completely free for everyone who is subscribed to the newsletter. We're going to run through each one as we can see. We're going to talk about a lot of information, and we're going to talk about our upside and whether or not we see each one as undervalued. Now, for those that are interested, you can sign up completely free in the pinned comment below. We also run through lots of different articles talking about a wide variety of things in the finance stock market world. And again, you do get instant access, and we will be sending that article on Monday. So the next undervalued dividend king we have is Target Corporation. Over the last 12 months, well, it is up around 7%. Over the last 10 years, it is up around 141, has marginally outperformed the S&P during that time, but as we can see, it hasn't quite recovered from the all-time highs around $262 around 3 years ago. So in terms of the value, it is sitting in the midpoint of the 52-week range. We do get one buy rating from Wall Street with a double hold from the others. Similar to PepsiCo, a yield above 3%. In terms of a forward P, lower than PepsiCo, sitting around 15.5. Dividend safety, well, 80, so it looks to be safe. Market cap, 67 billion. It is a large cap company, and as we can see, it was reaffirmed. Dividend cut looking unlikely. In terms of the last recession, well, no surprises, they increased the dividend. They are, after all, a dividend king. We see above average growth, pretty much flat during the last recession, although they did marginally trail the S&P, negative 61%. Now, one of the reasons we love this company, they had double-digit growth to their dividend over the last 5 and 20 years. One of the reasons it was a bit disappointing last month with that trivial underinflation increase in June 24. As noted, they are a dividend king, 52 years, very similar to PepsiCo. They are one of the newer kings. In terms of dividend yield theory, well, we do again get that undervaluation signal, a double undervaluation signal with the forward P below the 5-year average. And when we do take a look today, we actually get a triple undervaluation. It is also significantly lower than the consumer staples of 18.1. Now, for consumer staples, below 40%, pretty much what we get across the board, 52 anticipated over the next 12 months. In terms of free cash flow, it has pretty much doubled over the longer term, expected to increase over the next 12 months, although a very marginal increase to note. And when we do look at the sales growth, nice to note, 3 to 7% is pretty much on track across the board, although we do have to say in the more recent year, negative 2% to their top line, but we can clearly see here around 40% over the longer term. They do something that we didn't see that much with PepsiCo. We're doing a lot of share buybacks over the last 10 years. And even though it is inconsistent, they do a fair number over the period. We then take a look at the ROIC, above 17% for consumer staples. That is again what we get over the longer term. So always great to see with a very strong metric. We would ideally like to see their margins a little bit better than what we see. Minimum 10% in the more recent year at 5% does leave a little to be desired. The same to be said as well for their free cash flow margin. In terms of the net debt to EBITDA, always great to see. Below the number we want to see is a maximum, as it does correlate to dividend safety and balance sheet strength, which are both very important. 1.75 in 24, expected there or thereabouts over the next 12 months. So in terms of the analysis for Target, an intrinsic value of $194, With our current price at 145, when we do use our margin of safety at 10%, we can see a buy at 175. And as always, when we keep going till it's near the current trading price, in today's episode for target, we do see a 25% margin of safety. Now, we do know Wall Street also see upside, although a little bit lower than our intrinsic value. They see 23% over the next year. So today's episode for target, whilst we see a 25% MOS and Wall Street see 23% upside, as always, we would be interested to hear your thoughts whether or not this is also one you have been adding. We then move on to a specialty chemicals company. It is PPG Industries, where we do also get a buy from Wall Street, although a double hold. The forward yield a little bit lower than the previous two at just over 2%. Forward PE just below 15, trading right there towards its 52-week lows, down 16% over the last 12 months. Over the last 10 years, it is up 20%, and we can see all-time highs sitting around $182. We get another very safe dividend score, always great to see. Market cap $29 billion, again, another large cap company, and also reaffirmed dividend cut looking highly unlikely. Now, they increased the dividend, they did have below average growth, and similar again to target, they did marginally trail the S&P. In terms of dividend growth, well, what I quite like is the consistency, 6% over the last 5 years, 6% over the last 20, and an above inflationary increase last July. So again, we are expecting an increase from PPG over the next few days. And as we can see, not only 52 years of increases, but they have been paying a dividend for the last 125 without a reduction. We also get that double undervaluation signal, which is always nice to note. And when we see the sector P for materials, PPG sits much lower than 19.6. In terms of the free cash flow payout, well, consistently below 60%, 27 expected over the next 12 months. So it is understandable how they are able to offer those consistent above inflation increases. With the free cash flow, we do note some inconsistency. Again, with this industry, you could argue cyclicality. Nice to note, expected some very strong record-breaking free cash flows over the next 12 months. When we do look at the sales growth, we can see 3 of the last years have in fact been negative, but over the longer term, we do see at a minimum it has increased in line with inflation. On top of that, we do note some share buybacks, although over the last few years, they have been very minimal, if any. We then look at the ROIC, consistently above that 10%, so always a great sign. Does make it attractive for potential investors. And when we look at the margins for both operating as well as free cash flow, it is pretty much around that minimum levels that we do want to see. Net debt to EBITDA as well, 1.74 in 23, around that expected over the next 12 months. So no worries, again, no surprises why we are satisfied with that dividend score. We then move on to the intrinsic value, $150, current price 125, 10% MOS, a buy at 135, 15% around 127, not quite at a 20% yet, so sitting somewhere between 15 to 20% for this dividend king. And what we also note is that Wall Street actually see more upside than what we've calculated. Their target 26%, $157 over the next 12 months. We then move on to the dividend king, which looks to consistently be undervalued. Johnson & Johnson, double buy rating with a yield looking very appealing, 3.4%, one of the highest offered over the last 5 years with them. Forward P below 14, down 11% over the last year. Over the last 10 years, up around 39%. As we can see, all-time highs sitting around the $182 mark, which it has hit a few times over the last few years. Dividend safety, well, the highest score obtainable at 99. Market cap, $351 billion. Mega cap, and again, no surprises, reaffirmed dividend looking very safe. In terms of the last recession, well, they had above average growth and they also significantly outperformed the S&P, so you could argue it is a good hedge against those who do believe that a recession could be inbound soon. In terms of dividend increase, well, they increased it 4.2% in April this year, so in line with inflation. Over the last 5 and 20 years, we do get that inflationary plus increase, which is always a good sign from any company. Not only a dividend king, but 108 years of paying a dividend without a reduction. As with the previous companies we reviewed, this is no different. We get a double undervaluation signal on both the yield and the 4P. One thing I want to point out here, this is a high yield that was offered by Johnson & Johnson with that COVID pandemic drop and that is a very large sign that this could be extremely undervalued. When we take a look at that sector P, we also note it is much lower than healthcare's 15.9. In terms of looking at the free cash flow, below 60%, pretty consistently around that level, so always a good sign. And when we look at the free cash flow per share, although marginal increases over the longer term, it is increasing with the expectation for that trend to continue. In terms of sales growth, well, steady moderate growth, again, that is what we get with this company. Don't expect like a tech company massive growth year on year. And as we can see, again, pretty much in line with inflationary increase over the longer term. Again, very similar, this does seem to be a trend with Dividend Kings, not a massive amount of share buybacks, although marginal ones over the longer term. And when we look at the ROIC, consistently very, very strong, always a great sign, something you should always consider when looking at other companies in your portfolio or on your watch list, as well as both operating margin as well as free cash flow margin looking very strong, very healthy, and well above the minimum. We then move on to the net debt to EBITDA. Below 3 is exactly what we get, incredibly low. Again, this is one of the best balance sheets globally. In fact, it is up there with the likes of Microsoft. 0.23 expected over the next 12 months. Again, just reinforces how strong that truly is. And our intrinsic value in today's episode, $172. With the current price at $145, a 10% MOS would be a buy at $155. 15, it would be 146. So pretty much at today's value, if you do see this as a high quality company, even with the bearish indications of those lawsuits and legal settlements hanging over their head, 15% MOS would be a buy at 146. Again, those at 20%, 137, and those at 25 around 128. So at 15% margin of safety, Wall Street upside 21%, as we can see their price target $176, marginally higher than our intrinsic value today. We then move on to Nordson Corporation with another buy from Wall Street, a hold from the other two analysts, a forward yield 1.2%, so on the lower end today, forward P around 24, and again trading towards its lower end of the 52-week range, down around 8% over the last 12 months. Over the last 10 years, though, it is up 195%. Bear in mind, if you reinvest dividends, it would be up higher, and this has also outperformed the S&P over the 10-year period. 94, a very safe score, 13 billion large cap company. It is in the industrial sector as well. No surprises, reaffirmed just last month. And in terms of comparison of the recession, while they increased their dividend, they had below average growth and they marginally underperformed the S&P. In terms of dividend growth, well, pretty strong. Inflationary increase at the minimum last August, double digit over the last 5 and the last 20 years. And as we said, Dividend King, so more than 50 years of consecutive increases. We then move on to dividend yield theory, where again, these are undervalued companies, so it would be a surprise if we saw an overvaluation signal. As we can clearly see, double undervaluation signal, although we do know it is essentially higher than the industrials 18.7. In terms of the free cash flow payout, not only below 60%, but pretty much below 30% every single year over the last 10-year period. We also notice some very nice free cash flow growth over the last 10 years. And when we do look at that sales point, what we see, 3 of the last 10 years have been negative, although we do notice some very nice double-digit increases over the same period. And as we can clearly see, the upward trend of their total sales, that is around 50% growth over the period. Again, very similar trend across all these companies. They do share buybacks, although they are very minimal and very trivial for discussion. In terms of the ROIC, well, nice to note, strong double digit across the board. And when we do look at those operating margins, again, very similar trend, both across operating and the free cash flow, very consistently higher than the minimums. Finally then, the net debt to EBITDA, not only below 3, but 2.1 in 23, expected to go below that over the next 12 months. So again, no worries at all. The majority of these Dividend Kings today do have that very safe score. In terms of the intrinsic value then, $267 with a 10% margin of safety, a buy at $240. 15% around 227. So pretty much at this level today for this Dividend King, not only do we see a 15% margin of safety, but Wall Street believe there is a lot more upside than our calculated intrinsic value. They see 23%, and they do consider this as a buy, as we mentioned at the beginning of the analysis. Now, as we mentioned, for those that prefer to look at ETFs for security, we're going to retouch upon KNGS, which is the Dividend King ETF. Now, they call this an elite group of over 30 companies with those 50 plus years of increasing dividends, and they talk about these being some of the most well-known companies. You may have noticed, those who are eagle-eyed, that the top 5 holdings has 3M. Now, this isn't a Dividend King anymore, and this is as of the 31st of March. As we're about to see with their top holdings, this has now been removed from this ETF. In terms of the expense ratio, very important, 0.35%, so it may be worth comparing that to others that you do hold in terms of ETFs, whether or not that is a little bit too high for you, or in fact something that is satisfactory. And when we do take a look at their top holdings, the first one, Black Hills Corporation, 5.33%, and then the others do have a fairly similar weighting, as we can see some very well-known names here. We have even Johnson & Johnson that we touched upon, AbbVie, Coca-Cola, Kenvue, National Fuel Gas, and as we mentioned, we are going to be setting up that spreadsheet with 49 Dividend Kings that will do a very in-depth dive, so make sure you are subscribed to the newsletter. And then to talk about their performance, given this was started November 2023, we can see that since inception, this is up around 9.83%. As always though, do let us know your thoughts about today's episode. Let us know if you are buying any, whether you're selling, or maybe some of these are now on your watch list. If you enjoyed today's episode, value was provided, smash that like button, hit that subscribe and bell button, and as always, we'll see you all on the next.